To jump in on this, and you've been watching the Inditex story like everybody else.
Yes, I think that the big problem here is the slowdown in the global economy in general. I think that what investors are nervous about is the growth in sales. And what you're going to continue to see is that those stories that are based on technology, those stories that are based on cost cutting, those stories where there's a differential, that's fine. But in general, forward estimates, I think, in my opinion, need to come down a little bit. Consensus is a little bit too aggressive in terms of growth of sales, and I think that the widening of the gap in terms of valuation between between Inditex and the others is going to continue to increase, because the difference is not anymore coming from just growth in sales. It's coming because margins are actually not under pressure, whilst in the case of this one in particular,
margins not under pressure.
But
May I dispute that?
Story.
You may, of course you may.
I think margins in this sector are devilishly under pressure.
Absolutely they are. I'm saying that in Inditex, the margin story is more robust, is less under threat than in all others, and that's where you have the problem of derating.
So the companies I've spoken to, I mean, L'Oreal's a great example. They were saying to me that their margins have been improving because of the technology that they've been embracing. So I wonder whether we're now in this cycle, and everybody thinks technology is technology, consumer discretionary is something else completely. But I wonder whether consumer discretionary is starting to look a little bit more tech-like in terms of you've got revenue growth coming in, you've got the cost side savings. That they're also adopting, because there's been one sector that's really gone after it.
Close almost every session in the States.
It's technology, but consumer discretionary, yes, also had a decent day.
So I was actually agreeing with you. They are looking more. Well, I mean, they valuate. I worry about consumer discretionary valuation in the States, but then that's just me.
The interesting thing about Inditex is it's always been lauded for its back office technology rather than the front office, and what they seem to be able to do better than H&M and other retailers is supply chain management and product to market just in time in the right locations. And constantly they win awards for the fact that they have a system that seems to be somewhat different from the other retailers and somewhat faster. So I think it's just interesting. When we think retail, we often think, what is the sales channel? But it's not necessarily the sales channel that gives them the biggest margin or movement in the profit needle. Because let's face it, a white T-shirt is a white T-shirt, and there's probably 20 or 30 pence.
You sound like meat cutters, that's not true.
20 or 30 pence either side in terms of the price of manufacture. I mean, you know, it's tiny, but the key is how you get it to the customer at the point when they want it, with the brand on it that says, this is who I am.
The price of a white T-shirt can be anywhere from $2.99 to about £150. So that changes.
Price of manufacture.
That changes
it's the same product.
It's the
I
same
understand
product,
at the point of sale it changes.
Can I just say,
the key is
how
you then
from
take
white
that
T-shirts?
product,
Can I just say, this consumer discretion. This is what worries me about this sector at the moment. Consumer discretionary saw a fresh record in the States yesterday at 89.1.01 today's session, gaining 1% for its 10th session in a row. 10th positive session in a row. These are pretty nutty purchases at the moment. The momentum on this sector, way beyond perhaps the rationale, I would suggest, of investors sitting back, having a look at the valuations. They're just trading the momentum, aren't they?
I think that in the United States, what's happening is that we started the year with a very aggressive negative view about what the growth in sales, growth in consumption would be, and that the economy had peaked, that so many indicators were sort of, making the sector not be very attractive. So what you're getting is a lot of investors that are jumping in on the idea that the economy in the United States is strengthening relative to the rest of the world, in which there is an evident slowdown, particularly in the Eurozone.
And then we saw those retail sales yesterday. Coming up on this show, is it a shot across the bow for Beijing? I've got a reaction from China after the break. We're going to cross out to China as Mr. Trump readies a round of tariffs on Chinese goods.
It's an extraordinary situation, Eunice, isn't it? Thank you very much for that.
It's crazy, isn't it? Just to add one thing, there's a story which I'm doing for MSN today later on, and it's about soya farmers, yeah? And soya farmers, the big states, Iowa, Illinois, Minnesota, Nebraska, Indiana, Missouri, Ohio, and Dakotas, they're the ones who are going to be voting in the midterms, not employees of ZTE. And they're the ones who are appealing to Congress to stop this whole thing now. I think it's very interesting. Is he pitching himself against the farmers? These guys voted for him.
No. I think that what he is doing is negotiating very, very aggressively, knowing that the other side, China in particular, is unable to retaliate in a way that is going to hurt the U.S. economy. The U.S. economy is a very low exporting economy. It exports around less than 12% of its GDP. But on the other side, you have China, who has not only massive industrial overcapacity, but needs to export more. And more importantly, it cannot grow 6.5% without the massive trade surplus with the United States. So this is a negotiation tactic. And what you know is that time doesn't work in favor of one side, China, and what the US is trying to do is to achieve something in return. And think about this. Every time that Trump presents a new set of tariffs, we find, oh surprise, a new set that existed already of tariffs that China is lifting. So, in fact, what we're actually seeing is the unveiling of so many hidden tariffs, so many hidden protectionist measures from the European Union, from China, that ultimately will end up in a different perspective.
But there are some very specific industries. I mean, General Motors sells more cars in China than it does in the United States domestically.
Sure.
And most of the US automakers manufacture and assemble with Chinese finished parts.
Absolutely.
So there will be significant consequences for some industries if Trump continues down this road.
Because there will be no trade war. This is not a trade war. This is a negotiation. This is a negotiation in which the US, as your biggest customer, is saying, look, this is unfair. So we need to find a common ground.
Right, let's hold off. 33 minutes to go before the start of trading on these European markets. FTSE futures called mildly lower at the start.
But isn't it a bit of let's say, not understanding reality? I mean, seriously, you have 1.7 trillion euros of QE. Credit growth is simply not happening. It's down. It's 7 consecutive months of weakening data in the European Union. The inflation expectations have gone up only because of energy prices. Thank you very much. That's great for the economy. And at the same time, you have slowdown in industrial production in Germany, in France, in Italy, in Spain. Where is the positive? Above trend? Obviously, the trend is a disaster.
Well, I don't know if I'd determine that. That's going to be determined by productivity and, of course, population growth.
But productivity growth is in existence.
It's
weak in every country.
Yes, but that's why policy's still accommodated. Remember, we've still got negative interest rates, and he's talking about maintaining negative rates through to the end of next year. Who decides it's not working? Growth is better than it was last year.
Right? But no, it's not, by the way. It is not going to be better than last year, according to his own estimates. It is actually weakening. No?
Yeah, but again, you look at the forecast, growth around 2%, maybe a shade below. That's reasonable. Again, you've got to play the hand you're dealt, and it's got issues.
Do you think that Draghi is forgetting the fact that Europe maintains overcapacity, maintains very high levels of debt, and maintains very, very aggressive government spending ratios that hinder growth?
Yeah, I mean, he's the governor of the central bank, right? He's not a politician. He doesn't set fiscal policy. So again, there's got to be some balancing on the fiscal front, but that's not the mandate for the ECB, right? So the ECB's job is to deal with monetary policy, right?
Can I ask?
What I think is that on a relative basis, it's true that Tesco's much better placed than its competitors. And if you think about the challenges ahead, so moderate slowdown in the economy, we have probably seen all of the tailwind of growth in consumption and wage rises. So all of those things are behind us, but you still have a number of, let's say, differentiating factors. And I think that predominantly is the fact that they can shield some of the margins from downward pressures because of the actions that the CEO has taken, and obviously the possibility of deals with technological companies. But the sector is fundamentally under very, very large pressure because of all of the strategy that it has had as a sector in the previous 8 years, which was basically to build more and more and more close to each other, to try to absorb and to take away a little bit of competition from a diminishing pie. And I think that is going to continue to make the sector suffer because people are not going to spend more in an environment of uncertainty.
And some of that pressure, clearly, they're going to try to pass some of that pressure down to the food suppliers and the farming industry itself. So unquestionably, they're going to try and continue to squeeze their suppliers. You're going to see some further consolidation in those sectors in due course. And interestingly, in the UK, one of the worrying stats, I guess, is the fact that if you look at the number of store closures or the number of people laid off in the sector this year, for example, even though we're only halfway through the year, is significantly high numbers compared to previous years, which implies it's not just the small mama and papa shops being affected, it's spreading to some of the more medium, larger sized businesses.
Kevin, what do you describe this? Makes me feel as though the party's about to end, so you need to sort of drink rapidly, consume rapidly before that happens, which might explain, Dan, some of the euphoria still on markets and the appetite for risk that we're seeing, and even around Argentina that we were discussing this morning.
Absolutely. I think that what we're seeing right now is that every dip, people, instead of being more cautious, what they're taking is actually more risk. They're looking at the riskier side of the spectrum to increase their portfolios. And I think that if you want to protect yourself from that euphoria, what you probably need to do is a combination of U.S. Treasuries. I think that U.S. Treasuries always are a good opportunity there. Dollar-backed assets, investment-grade assets, fixed income in the United States is very attractive because the debt ratios are very, very low, and at the in investment grade. And at the same time, what you would have to do is start to look at recession trade type of companies, the McDonald's, the Campbell's, the Philip Morris's, those kinds of companies.
And I think there's
Ben, do you know?
Well, I think
And
probably
what time is it going to be?
well, I must check. I'm free.
8:30 on the 7th of July. Yeah.
I'd have thought March probably, but
March,
no. Confluence events really. We've got central bank tightening, but so far they're tightening into a recovering economy. But next year things might look a bit different, and gold might be doing better.
What about inflation? Because I think that the fourth element is obviously that gold tends to be an inflation hedge. People fear that central bank policies can drive inflation too high, and therefore there was a big trade buying gold ahead of that risk of high inflation. Didn't happen, and actually inflation expectations are coming down. So probably that explains quite a bit about what's happening to gold, in the sense that what people fear is actually not an inflationary outcome of QE and tightening, but a deflationary one. And how do you see that actually?
Yeah, I thought it was quite interesting on Wednesday when the Fed was more hawkish than I think most people expected. Gold actually rose. Yeah. Now, we're talking like $6 or something, so perhaps we shouldn't read too much into it. But for gold, that's a big move, And I think probably the sort of the consensus, or dare I say the counter-consensus trade, has moved from the Fed's behind the curve to the Fed might be ahead of the curve. Inflation perhaps to the fear of slowdown and recession.
Sure.
Actually, if you look at the gold price over the last 20 years, it's been recession that's been good for gold, not inflation.
Absolutely. So do you think that actually what could change the tide then is the evidence of recession instead of a global I think that the market is moving to a global slowdown on an already very optimistic expectations of growth, so nothing bad about it, but a change into a recessionary mentality.
Yeah, I think so. I always say, and I've said it on this program before, gold does well when central bankers are losing control. At the moment, they look in control to me, so I think short term we could go a bit lower.
Yeah.
Next year might look a bit different. What about rally? So possibility, and we're not particularly bearish on gold. It's hard to see big movements at the moment.
What about the just to dip into the conspiracy theorists and the people that have Kitco as their first place to go every morning to check the price, that the Chinese and the Russians have been accumulating for central bank reserves in favour of owning a hard metal rather than the greenback as they look at rising US debt levels. I mean, again, is that what is providing the support here at $1,300?
Well, on one hand, that's not a conspiracy. China and Russia have been buying gold quite aggressively in the last 10 years. In fact, they've been the only central banks buying gold, but they've bought maybe 1,000, 1,500 tons of gold, a large amount. Now, perhaps they're buying more than that. The Chinese don't really publish figures anymore. I think definitely in the case of the Russians, they've been trying to get away from dollar assets.
Yeah, no, the Russian central bank is clearly the most aggressive in that sense, because relative to money supply, the Russian economy is the one that has the most gold-backed economy, and despite that, the ruble continues to weaken. But I think that the fundamentals are what are supporting the price there. Is that the buying is very, very robust, no?
Yeah, I'd also say that Turkey's been buying gold as well, central banks. So, you can see reasons why there as well. So I think in some ways it's not been so good for gold that you haven't seen, let's say, mainstream central banks buying gold. 10 years ago, India and Brazil and Korea, they were buying gold, and you haven't really seen that. But no one sold gold. No central banks have been selling gold.
So what you've summed up is really a lot of negatives around gold at the moment. Is there a trade somewhere else in the precious metal space for those who want a bit more volatility, want a little bit more of a trading pattern that they can get in and out of?
Well, very related to gold, our favourite long is actually silver at the moment, because we think silver will benefit more. I'm still reasonably bullish on the world economy, actually. I think silver has lagged where it should be. When you see base metal prices rising, as you have done in the last few weeks, silver starts to rally against gold, and I think today's price against gold is the highest it's been for maybe three or 4 months.
Matthew? Oh, sorry, let's finish.
Well, so I think silver upside.
Fantastic. Matthew?
Italy's new Prime Minister Giuseppe Conte is set to meet French President Emmanuel Macron for a working lunch later today. Conte had considered cancelling the visit after Macron accused Rome of, quote, cynicism and irresponsibility for turning away a migrant rescue ship. The French president later tried to end the diplomatic dispute, saying he never meant to offend Italy. What is that doing to yields, if anything at all? In fact, Daniel, what is the story on Italian yields here now?
Yeah,
the crisis is over, isn't it?
Well,
we can all go back and safely own Italian sovereign debt.
Again, the ECB clouds disguises all of the risk, clearly, no? But there's an underlying problem. The underlying problem in Italy is this is an economy that has not grown at all in the last 10, 15 years. It's been 2 decades, almost 2 decades in stagnation. Is an economy that faces tremendous challenges in terms of maturities of debt now that QE ends. And at the same time, the new populist government, which puts together 2 extreme parties that had very little in common until they got together, is looking to spend a lot more, while at the same time talking of possible exits from the euro, etc. So very, very challenging environment. What we're seeing right now is that because the ECB continues to support, yields are coming down, equity markets are recovering, but the story is far from over, and I would definitely not be overweight Italy into 2019 at all.
Daniel, it's been quite a week for investors watching geopolitics, central banks, and now trade. As we wrap up the week, what's the #1 theme going into next week?
Into next week, I think the OPEC meeting is an important one, because a lot of what has been driving the equity markets and risk on appetite has been the perception of inflation.
Just on that then, what could be the scenario? We've got 30 seconds, 20 seconds. What's the scenario that could actually really hurt the markets?
The one that could really hurt the market is if OPEC decided to maintain the current agreement, because and we saw an increase in oil prices that could start to really hurt the economy. We're far from there, but a manipulated price
Daniel,
is the risk.
Got to leave there. And didn't even have the pleasure of speaking to you about Spain in the World Cup. Have they still got a team, or have they sent them home as well?
I don't know what's going to happen.
Just the manager, perhaps. Daniel Lacalle, Chief Economist, Treasury Gestion, thank you very much indeed.
That's it for us. Ralph Gines will be on the programme on Monday. Bye-bye, everybody. Have a great weekend.